SpaceX can report billions in quarterly revenue and still make the stock worse. Earnings land first. This is a business test and a capital flow test at the same time. I am not your advisor. This episode is about SpaceX, traded under SPCX in the current public market setup. That tells you the market is not rewarding the label alone, because public investors now have to value the machine, not the myth. Those are different kinds of numbers. A loss tells you the engine is still expensive to run and expand. The U.S. Space Force has awarded SpaceX $1.6 billion for 18 Falcon 9 launches under a space-based sensing and targeting portfolio, with completion expected by the end of 2027. More subscribers can mean a better revenue mix than one-off launch contracts. Now add the lockup. It is a rule that restricts early holders from selling for a period of time. It only knows supply could increase. If buyers step back, the same earnings report can land into a weaker chart. Third is the lockup shows whether current shareholders are willing to add supply near $108.37 below the $135 IPO price. SpaceX's moat is cadence. Every turnaround improves the economics of the system. Every delay reminds investors that hardware still has a schedule. Think of Starlink as a flywheel. Sell service. Now add national security demand. The Space Force award covers 18 Falcon 9 launches for space-based sensing and targeting. They do not eliminate execution risk, cost risk, or political risk. A public earnings report should help investors separate current cash generation from future platform spending. Investors should not put all three into one optimistic bucket. Listen for capital expenditures. Listen for Starship milestones that move from aspiration to schedule. Third is the post-earnings reaction range. If the lockup produces heavy volume and weak price action, supply is dominating the narrative. A call is a defined risk way to express upside. A put is a defined risk way to express downside or hedge a long position. You pay for protection. That lowers the upfront cost, but it caps the upside. So the cleanest rule is position size. No single earnings trade should decide the portfolio. Those are not SpaceX substitutes, they are sentiment gauges. Space Force contract, an IQPS booking that takes total booked launches for that customer to 18, and a Victus Haze mission completed on a compressed response schedule. The largest public space name can attract flows while the proxies sell off. Now the risks. A large revenue number does not prove the model is mature. They may also require years of spending before returns are visible. Risk 4 is execution. Rockets fail, satellites need replacement, subscriber growth can slow. A great company can be a bad entry if the price already assumes flawless execution. Then watch the lockup volume. My base case is that this is a volatility event before it is a direction event. The trade is in the reaction. If this breakdown helped, subscribe to Launch Money TV. Not financial advice, nothing in this video is financial advice.
That is the counterintuitive setup before its first public earnings report. And on August 6th, a first lockup window is expected to make about 911 million shares eligible for sale. Do your own research. It is not about the old SPAC ETF with a similar symbol. Start with the tape. The company has the launch brand, Starlink, a massive capital base and the most ambitious growth story in the sector. Current coverage points to second quarter revenue of $6.87 billion and a loss of 16 cents per share. Bucket 1 is launch. That is contracted demand. It also means launch is no longer only a commercial narrative. More satellites can mean more capacity. More capacity can mean more subscribers. Bucket 3 is the expensive option. These projects can expand the addressable market. A lockup is not a verdict on the business. The market does not know the final choice in advance. If buyers stay aggressive, new shares can be absorbed. Second, guidance tells you how much capital the next build-out needs. A strong report does not automatically beat a supply shock. The reaction depends on expectations and positioning. Every successful Falcon 9 flight reinforces customer confidence. The latest market coverage also points to a successful launch of 24 Starlink satellites. Launch satellites. The flywheel works only if demand, pricing, and reliability stay ahead of replacement and deployment costs. Government contracts can stabilize demand. Starship is the platform investors associate with the next jump in payload, reusability, and mission scope. Launch revenue today is not the same as Starship value tomorrow. That is where the earnings call matters. Listen for Starlink subscriber growth and pricing. Now translate the story into a trade framework. Second is the $135 IPO price. If earnings beat, guidance rises, and the stock holds above the pre-earnings reaction low, that is confirmation that demand is absorbing the event. If the stock does not move enough, the premium can disappear even if the company remains strong. A call spread buys one call and sells another at a higher strike. A put spread does the reverse for a downside view. Use less capital when the event has two separate catalysts, earnings and a lockup. If SpaceX pressure pulls capital out of smaller names, RKLB and ASTS Space Mobile can move even when their company-specific news is unchanged. SpaceX can be both the company in this episode and the launch provider inside another company's catalyst. It is also about where liquidity is willing to sit. Risk 2 is capital intensity. AI infrastructure and Starship may create future value, but the possibility can change the behavior of every buyer and seller around the event. Regulation can change. Risk 5 is valuation. The clean way to approach this week is to separate the layers. Do not confuse a successful launch with a successful investment. SpaceX can print strong revenue and still trade lower if investors focus on spending or supply. We track missions, contracts, capital flows, and the space stocks connected to them. Do your own research before making any investment decision.
The latest reported close shown on the market chart is $108.37. The IPO price was $135. Supply arrives next. Nothing in this video is financial advice. This is for educational and entertainment purposes only. The ticker, the price, and the lockup calendar are the story. SpaceX is below its $135 IPO price. The stock still fell. Why? The first reported quarter gave the market $4.6 billion of revenue and a $4.2 billion net loss. Revenue tells you the engine is large. Break the story into 3 buckets. Falcon 9 cadence creates revenue, operational data, and a reliability mode. Bucket 2 is Starlink. Recurring connectivity revenue is the part of the model investors want to underwrite. AI infrastructure, data centers, and Starship, they can also consume capital before they produce a clean return. When the window opens, eligible holders can sell, hold, or wait. That matters because price is an auction. First, earnings tell you whether revenue growth is converting into operating leverage. A weak report does not automatically break the long-term thesis. Now move from the spreadsheet to the pad. It launches often enough to turn each mission into another operating data point. That is not just a launch headline. It is another increment of network capacity. Add coverage. Use service cash flow to fund more network expansion. That creates a visible pipeline and ties the company to government mission requirements. Then there is Starship. It is also a capital sink until the system reaches dependable cadence. That distinction matters. Starlink subscribers today are not the same as AI infrastructure revenue tomorrow. Listen for launch cadence. Listen for the timing and scale of AI infrastructure. For the stock, mark 3 zones. First is the current reference near $108.37. If revenue beats but the stock sells off, the market may be saying the spending burden is too high. Keep the options discussion plain. You pay a premium for the right, not the obligation, to buy at a chosen strike before expiration. If the stock rises or stays calm, that protection can expire unused. These structures can make the risk visible before the trade starts. For comparison, the current pre-market quotes show RKLB at $64.95 and ASTS at $58.98. RKLB has its own execution case, a record $266 million in backlog. ASTS has its own binary catalyst. Bluebirds 11, 12, and 13 are scheduled for a Falcon 9 launch on August 5th. That is why capital rotation matters. The trade is not only about fundamentals. Risk 1 is profitability. Investors need to see margins, cash flow, and the cost of expansion. Risk 3 is supply. About 911 million shares becoming eligible for sale is not the same as 911 million shares hitting the market. Government schedules can move. Watch the earnings facts. Watch the capital spending plan. Watch the post-report price. Do not confuse a bad trading day with a broken business. It can also regain momentum if recurring Starlink economics and launch demand show real operating leverage. Photos, NASA public domain, Wikimedia Commons. This is for educational and entertainment purposes only.